Hi, my name's Roy Thompson. I head up Carpenter Box Financial Advisors. And on the 5th of March 2025, we ran an investment and tax seminar. And the purpose really was to give a little bit of insight to what was happening in the economic world. Of course, since Trump came to power in the US, there's been a lot of volatility, I think a lot of hearsay around some of his policies. And certainly, as we've seen over the course of the last month or so, some of those have started to really take effect in terms of investment markets. When we look at a volatile market, we also have to think about the tax implications. Certainly, Rachel Reeves here in the UK is seeking to take a bigger tax take, primarily from investment returns. So we've seen fiscal drag, frozen personal allowances, reduction in capital gains tax allowances, increase in capital gains tax rates. All of these things affect investment returns as they give the government a bigger take on the return and of course, the investor a slightly smaller take. We've also seen inflation over the course of the last few years peak and then retract, but it hasn't retracted back to the pre-Ukraine war days. And we've seen interest rates move in line with that. So an increase in interest rates and then a slight retraction over the course of the last year or so. I think the big change from my point of view in terms of financial planning was really around the pension rules. There was a lot of speculation pre-budget around some of the rules that would change. I took a lot of phone calls from clients worried that tax-free cash would be taken away from their pension arrangements, or that there would be a reduction in the rate of tax relief on contributions that are made. In the end, none of those things happened, but there was an announcement that from April 2027, pensions would no longer be an exempt asset for the purpose of inheritance tax, and indeed that they would fall into your inheritance tax calculation. The implication here is that whilst the pension will form part of the estate for inheritance tax, it will also have to pay some of the inheritance tax. And in practical terms, that means that your pension scheme administrator is going to have to liaise with your executor when it comes to wrapping up your estate and obtaining probate. Clearly, if you've got individuals who've got 2 or 3 different pensions and or pensions that they've lost track of, that's going to be very challenging for pension scheme administrators and executors to work together to bring the tax to HMRC in a timely manner. So it is something for us to keep an eye on. We have some early thoughts in terms of how we might want to think about planning our pension arrangements to mitigate what will become an additional tax on the estate. I'd encourage anyone who's got pension arrangements such that they will be in a position where they might be suffering from inheritance tax on their total estate when the pension is added, to seek advice. To seek guidance. I've already had a lot of people saying, look, I think I need to do this, or I think I need to do that. But actually, we do need to take a considered approach. There are a number of practical implications that we need to think about. I'd underline, if you're unsure or want to talk about your finances against the budgetary changes, or indeed what's happening fiscally or economically in the world at the moment, please do get in touch at carpenterboxfinancialadvisors.com. Thanks very much.